Here in Chapter 5, we will eventually be able to prepare a corporate income tax return. We need to learn specific tax rules that apply to corporations. But first, let's compare the taxation of individuals with corporations by going through the tax formula. So we can see that both have gross income they need to report. Some income can be exempt. We'll talk about some exempt income in this chapter. But then we get to subtract out deductions. So in the case of a corporation, the assumption is that all the deductions are business related. Now we're going to find out there are some deductions that you cannot deduct on the tax return, non-deductible. But generally they're still considered to be business expenses, business deductions. In the case of individuals, we need to determine whether these deductions are business related or other type of deductions that are also subtracted here from the taxpayer's gross income to get to the taxpayer's adjusted gross income. In the case of a corporation, there's no such thing as adjusted gross income. Then for the individual, we subtract out the itemized deductions or the new 2018 higher standard deduction. So you can see deductions appear all over the formula in the case of an individual. But ultimately, we come down to the taxable income amount. And now in the case of a corporation, it's taxed at a flat 21% corporate income tax rate. In the case of individuals, the income tax rate can range from 10% all the way up to maybe 37%. Okay, that's the regular income tax. Now, there may be some other taxes tacked on to the regular income tax. In the case of a corporation, there used to be, at least prior to 2018, an alternate minimum tax. At the end of our Chapter 5, it mentions this is no longer applicable, although the AMT still may apply to individuals. And if you remember from the previous chapter regarding entities, the individual may be also subject to the net investment income tax, also the self-employment tax. What was the other one? The additional Medicare tax. So all of these taxes, other taxes, are not applicable in the case of a corporation. We do have credits, and we'll see one credit in the case of a corporation at the end of Chapter 5. Prepayments, in the case of a corporation, they have to pay estimated taxes during the year, maybe more specifically by the individual 4 quarters. That may be also true for individuals, but in the case of most individuals who work as employees, they have income taxes through withholdings, through their paychecks. And of course, any leftover could be refunded or a balance due for both the individual and the corporation. We usually start off preparing the tax return by first looking at the company's, the corporation's financial statements. And specifically, that's the income statement. And some of the income may not be taxable on the tax return. Some of the deductions may not be deductible on the tax return. Also, there may be income not reported on the financial statement that is now taxable on the tax return, or deductions not deducted on the income statement but now deductible on the tax return. Another term for income statement is called book income, and another term for tax return is just called tax. So there's going to be differences in income or revenue or deductions and expenses between the book income and the tax income. And we're going to try to identify that here in Chapter 5. and whether the differences have to be added or subtracted from one or the other to make the taxable income bigger or smaller. Okay. Some companies may prepare their financial statements not using GAAP rules that we learned in past accounting classes, but they may be um, preparing financial statements just for internal purposes. In other words, they don't pass on a financial statement to a banker or to shareholders or to the government. That probably will require GAAP prepared, really accrual basis method of accounting prepared financial statements. Maybe the only reason some smaller corporations need a financial statement is to prepare the tax return. So why not prepare a financial statement based on tax rules versus GAAP rules? It makes things much simpler, so you don't have to convert this so-called book to tax adjustments we're learning in this chapter. Preparing a financial statements based on non-GAAP is sometimes called other comprehensive basis of accounting. So that has to be disclosed on the financial statement. Could be cash basis, could be a combination of cash or accrual called modified accrual or hybrid, or could be, again, if the only thing you need the financial statements for is to prepare your tax returns, your financial statements could be exactly like the tax return, the tax basis financial statements. But that has to be disclosed right on the financial statement so it's not misleading. It's not automatically assumed now it's going to be GAAP based. So those differences between book and tax can either make your taxes bigger, we call that unfavorable differences, either making the revenue bigger or the expenses smaller, resulting in a taxable income that is larger, and ultimately now you pay more taxes. Again, unfavorable differences will increase taxable revenue, will decrease deductible expenses. Now, just the opposite can be true for these differences. If the differences will reduce revenue or increase deductible expenses, thus taxable income will go down and you pay less taxes. So these types of differences are called favorable, resulting in less taxes being paid as compared to the net income being reported on the income statement. Another way of categorizing these differences, okay, one way of categorizing it is whether it's favorable or unfavorable. Another way of categorizing these same differences is whether the difference is permanent. In other words, it won't change back the other way again. It's either favorable and won't change back in a future year to be unfavorable, or it's unfavorable now and it will not change back to favorable in the future years. Again, that type of difference is called a permanent difference. And we'll go through examples of all of these. Yeah. Now, if the difference is favorable this year but unfavorable in future years, or unfavorable now and favorable in future years, then it's going to reverse. So those types of differences are called temporary. Okay, so differences can be classified either as permanent or temporary, and favorable or unfavorable. I guess for tax purposes, the most desirable type would be favorable type that's permanent. In other words, it saves you taxes now and won't cost you in the future because it's not going to reverse to be unfavorable. Let's take a look at how we prepared financial statements. So if you remember in your first accounting class, what we had done was record transactions in a book called a journal. Yeah, so anything that happened, we had a transaction, we journalized it, and when we had enough journal entries, we would then post our journal entries into a book called a ledger, maybe a general ledger, divided up into pages, one for each account we keep track for our company. And then at the end of the period, be it a quarter or a year, we take the balances from all the ledgers, the last balance, and we put it on a two-column so-called trial balance to get just the total of each account, the balance of each account by the end of that period. And it's from this trial balance we could prepare our financial statements, although we would need to update the balances. And the only way to update the balances here in our general ledger is to first journalize the change. And if you remember, we call those end of the period changes adjustments. That also gets posted, updating the ledger balances. And now if you pull the balances out, you now have an adjusted trial balance. And it's from this adjusted trial balance you can prepare your financial statements, one of them being your income statement. And that's our starting point really in this chapter, the financial statements, income statement, the profit and loss statement, which is not ready to just take the numbers and plug into a corporate tax return, but we gotta adjust the revenue and adjust the expenses to comply with tax laws. So we could probably just add it on to a worksheet here as part of the trial balance. You don't need to journalize and post these differences for tax purposes, but just on a worksheet you can, and that's shown in our textbook, to update the income statement amounts so now they're ready to be put on the tax return. So we haven't even seen a tax form yet. It's all this accounting paperwork being done, getting ready for us to prepare to fill in the tax form. Okay, so eventually the tax form would be a form 1120, and just parts of it is shown in chapter 5. Um, in the next video I'll show you most of the whole 1120 form, of which you probably will need to fill out for one of our tax return projects for the semester. Again, the differences between book and tax can be grouped into different categories. One of them being either permanent or temporary, and the other being favorable and unfavorable. So on this screen are differences that will only happen for this year and not change back the other way in future years. But again, these changes can either increase your taxes or decrease your favorable taxes, your unfavorable, increase your tax. So going through this example, and this list is recreated in our textbook, in the case of interest that you earn from investing in municipal bonds, that type of interest is tax-free. It's revenue on the income statement. When it comes time to prepare your income tax return, it's not taxed. It's tax-free. So that's a favorable difference. And it won't turn around in the future year to be taxable. So this is a permanent difference. If your corporation is the beneficiary of a life insurance policy, generally that is tax-free income. It's still income reported on the income statement, but tax-free on the tax return. So it's a favorable, permanent difference. But you know, life insurance companies are not going to pay out their proceeds for free. It's going to cost whoever is the owner of the life insurance policy, and the cost is called a premium. And because the life insurance proceeds are tax-free, the cost of the insurance is non-deductible. Still shows up as an expense on the income statement, but you cannot deduct it on the tax return. So this is a permanent unfavorable um, difference. In a way, it is kind of like a temporary, right? It's unfavorable here, eventually turning favorable in the year the employee passes away. Um, One of the rules of taxes is that business meals are not fully deductible. 100% will show up as an expense on the income statement, but only half, 50%, gets to be deducted on the tax return. In the case of entertainment, the rule has changed for 2018 and future years. It used to be the same as business meals, 50% deductible, but beginning in 2018, it's 100% non-deductible. So still deducted on the income statement and zeroed out, not deductible on the tax return. So it increases your taxes. And nothing changed here in the case of government fines and penalties and political contributions. It shows up as an expense on the income statement, but not deductible on the financial statement, on the tax return. Excess compensation. I'm not sure if our textbook talked about this, but certain public corporations, when they pay their top 3 or 4 executives more than $1 million per year, that excess is non-deductible on the tax return. Still expensed on the income statement, but the excess non-deductible on the tax return, increasing the taxes for the corporation. Here's what we're trying to calculate in this chapter, the federal income taxes for the corporation, and the tax itself is non-deductible. Now, what's strange is that state income taxes are deductible, but the federal income tax is non-deductible, so you need to what they call accrue, if you're accrue basis, the amount of state income taxes for the year and deduct it even though you haven't completed the state income tax deduction calculation yet. So it's an algebraic formula you need to do to figure out that deduction. But again, here it mentions federal income tax, non-deductible on the tax return, still shows up as an expense on the income statement. And an expense that does not show up on the income statement, but we get to deduct it anyway on the tax return, is a dividend received deduction that's going to reduce your taxes. And we'll talk about this calculation, I believe, in the next video. Let's take a look at these permanent differences again by maybe kind of picturing a company's income statement. Remember, we're using GAAP rules, generally accepted accounting principle rules, to prepare the income statement, where we have revenue, all the different ways of making money, and the associated costs for that, the expenses to get the company's net income. Okay, so here's the company's income statement. But we cannot take these amounts and put it on the company's tax return. Specifically, this would be a Form 1120. And of course, we're following the Internal Revenue Code rules to prepare this 1040 return. But just like the income statement, we're going to show revenue or income minusing out the deductible expenses or deductions to get not net income but the taxable income that we would multiply by probably 21%, that flat rate, to get the federal income tax. Okay, the thing we're trying to calculate, the main thing in this chapter. Let's see. So some of the revenue, or let's say most of the revenue reported here, is going to be transferred onto the tax return. But maybe some, like that life insurance proceeds or the municipal interest, it's not going to be taxable. We'll call it tax-free up here. Okay, not taxed on the tax return. And most of the expenses will be probably transferred on the tax return and deducted, but some are non-deductible, not subtracted on the tax return. Okay, so taxable here and deductible here. But some not taxable, some not deductible. And if it's just for this year, and this here not going to be taxable in future years, and this not deductible in future years, then these changes, you see the change here, is permanent. Okay, this first category versus the temporary one. Now, an expense that's going to be deducted on the tax return but doesn't show up on the income statement on the left side, let's call this a non-cost. Doesn't cost you anything, or that you don't pay out any cash for this type of expenses. And that's the dividend received deduction that we'll learn about at the end of this chapter 5. Maybe another type of non-cost deduction that we had learned in the depreciation chapter a couple of chapters ago. If you remember, there was something called percentage depletion. You can't deduct it on the tax return because it doesn't involve any cost. It's really a percent of the income of that depletable asset. Okay, so we deduct it here on the tax return, and it doesn't show up on the income statement, and it won't show up in any future years on the income statement. So these are permanent differences illustrated here. And again, examples are on this list and also in the textbook. Let's take a look at temporary differences. Again, temporary because they'll reverse themselves in future years. An example we'll see discussed more later in the slideshow is when you have an investment in another corporation, one corporation investing in another. Depending upon how much control or percentage interest you have in that so-called subsidiary, it may require the parent company to report part or maybe all of the profits of that subsidiary in the parent's tax return. There could also be dividends being paid from one subsidiary to the parent, and that may come into play in any type of calculation of this book to tax difference. A very common difference would be, temporary difference would be depreciation, especially with the current laws with so-called bonus, extra, and Section 179 depreciation, where you accelerate a lot of the depreciation in the first year you put the asset into use, depreciable use. And that means there's not going to be any or less depreciation in future years. But eventually those future years will catch up, equal to whatever the cost of the asset was. Okay, and because it's reversing itself in future years, this is called a temporary difference. Related to that, if you deduct the cost right away, that will leave you a smaller book value or depreciable basis. And if you get rid of that asset sooner, that's going to result in a bigger gain or a smaller loss than if you were using a slower method of depreciation like straight line. That is the most common method probably on the income statement. So these two here are kind of related also here. Bad debt expense, you guys learned about the allowance method, trying to match up the uncollectible with the related sales revenue. Well, that's not allowed generally for most companies for tax purposes. You have to use the direct write-off method for tax purposes and only deduct a bad debt expense in the year you actually write off the receivable. There is no such thing as an allowance for doubtful accounts for tax purposes. Okay, so that's a timing difference, temporary. Yeah. Eventually, in the long run, if you were to stop selling, catch up and match each other. be it the allowance method or the direct write-off method. In your accounting 202 class or intermediate cost accounting class, you guys learned about capitalizing the manufacturing overhead into the cost of the inventory. And you cannot deduct that cost until you sell that inventory. In the case of financial accounting, though, some of that is not as strict. You can usually deduct a lot of that overhead costs, especially if it's administrative, not really direct into that item being manufactured. So in the case of tax, it kind of slows down the deduction. But when you eventually sell the inventory, it catches up. So again, just a timing difference. For organization and startup costs, GAAP says you deducted right away. Tax says you can deduct, I think something like 5,000. I'm not sure about the exact amount. It's under the intangible section of the depreciation chapter. A certain dollar amount in the first year, then you amortize it over X amount of years. I think it's 15 years. Yeah, so it kind of slows down the deduction. Unearned revenue, something you guys learned in accounting 201. You had to credit that liability on unearned revenue account until you earned it. Many times for tax purposes, you got the money in advance, so you have to report it right now for tax purposes. But in the long run, it'll match up revenue later, which on the financial statement, which is matched up with revenue now on the tax return. Deferred compensation, again, you try to match up the period in which the people working are earning this compensation, whereas for tax purposes, you probably can deduct it only when you pay it. More timing differences. We'll see examples of stock options, the effect of claiming an expense for issuing out these stock options and eventually the exercise. Again, that's a timing difference. So you sell a capital asset, and if you have a net capital gain, you just report it as income, both financial and tax. But if there's a loss, net loss, you still report the loss on the financial statement. But for tax purposes, you cannot deduct that loss to offset other income. You can carry it back to 3 years or 2 years or 1 year ago, reducing the capital gain in those past years, possibly reducing the tax for those years. So those years now have a timing difference with a benefit of claiming this loss being carried back. Or you carry it to next year for the next 5 years and offset capital gains in those years, reducing the tax for those years. Again, deferring the tax benefit to those years. But right now, you cannot deduct any excess net capital loss on the tax return. Likewise, for business losses, net operating losses, the rule now is you only can carry over from 2018 to future years. You can't carry back. So again, you still show the loss on the income statement, but technically on the tax return, your taxable income cannot go below zero. Any of this so-called operating loss is carried over and used up in future years, benefiting, reducing the taxes in those future years. Goodwill, that strange intangible asset, you have to follow that impairment rules for GAAP, for financial statement purposes. Whereas for tax basis, you get to amortize that goodwill from the very first year you acquired that asset. I believe it's over 15 years. So if you write off your goodwill early, impaired early in financial accounting, then maybe that could accelerate the deduction faster than tax basis. Let's take a look at some examples of the principle of temporary differences. So again, we have our financial statement, income statement based on GAAP rules. Usually that's accrual basis. And then we have the revenue we report, minusing the expenses we deduct to get the company's net income. Again, all showing up on the income statement. And here's our 1120 tax return showing the income minusing the deductions to get not net income but taxable income. So let's talk about the revenue first. Some revenue is going to be accelerated. That's put on the tax return earlier. In other words, let's say now, and then later on for tax purpose, financial statement purposes. An example of that would be that unearned fees, unearned revenue. You report it now on the tax return because tax rules say if you got the money, you report it. GAAP rules say, no, you report that income when you earn it, when you provide the service. Okay, so you can postpone that. But eventually they match up. And the difference is only a matter of time, a timing difference, a temporary difference. Or maybe the income is reported now on revenue. Let's do it this way now, but then you postpone it and you report it later on the tax return. An example of that would be maybe an installment sale. When you make the sale, report it now, the profit now. If you elect to go installment sale for tax purposes, you report the gain later on when you collect the money. Collect half the money during the year, you report half of the gain. You record none of the money being collected this year, none of the gain is reported for tax purposes on the installment method. Let's look at the next line. That's the expenses or deductions. Again, you can either, when you postpone it, it's called a defer, yeah? Again, accelerate the deduction on the tax return or defer to later on. So maybe you deduct it now. Remember that bonus depreciation? But for financial purposes, it's reported later on, slowly. Straight line method over many years. Or let's say you report the deduction now, yeah, and defer it here on the tax return reported later. An example of that would be the stock option. We'll see an example of that. Okay, so because the deduction, because the income eventually is going to be the same on over many years, these differences are only temporary versus the permanent we had seen a couple slides ago.